Welcome to The Explainer. You know, we love breaking down big ideas, and today we're going to try and decode the philosophy of maybe the most successful investor in the world, Warren Buffett.
So get this, from 1964 all the way to today, that's the compound annual growth rate of Berkshire Hathaway's book value per share. I mean, what an incredible number.
And to put that into perspective for you, it's more than double the return of the S&P 500 over that same huge stretch of time. That's just legendary performance. So, the big question is, how on earth did he do it?
All right, so we're going to break it all down for you. We'll look at his checklist, see it in action, and even get into the psychology of it all. But first, we've got to start with the masters who shaped his thinking.
Okay, so let's jump right in. You know, Buffett's whole approach, it's not some kind of magic trick. It's actually a brilliant mix of two core ideas he got from his teachers.
So on one side, you've got Ben Graham, his professor over at Columbia. Graham's philosophy was simple. Buy stocks like you buy groceries, cheap, based on the cold, hard numbers. But then, on the other side, you have Philip Fisher. Fisher said to look for truly exceptional companies, ones with a future that's built to last. He had this method called scuttlebutt, which was basically just investigating them from every possible angle.
And this is where Buffett's genius really shines. He took these two ideas that seemed totally opposite, and he merged them. He decided he was going to find those wonderful, high-quality businesses that Fisher talked about, but he was only going to buy them at the fair or even cheap price that Graham would have insisted on. It's the perfect combo. Fisher's quality meets Graham's price.
And here's the really cool part. This whole idea evolved into a super practical 4-part checklist that he uses for literally every single investment decision he makes.
So let's start with step one, which is maybe the most fundamental test of all, just understanding the business. I mean, if you can't get past this first hurdle, nothing else even matters.
He famously talks about staying within his circle of competence, right? He only invests in businesses he can actually understand. Things like insurance or, soft drinks. He stays away from complex tech that he just can't predict. He's also looking for a consistent history and, this is super important, what he calls an economic franchise.
So what's a franchise? Well, think about something like Coca-Cola. People all over the world want it. For millions and millions of us, there's just no real substitute for the real thing. And because of that, Coke can pretty much set its own prices. That is a powerful franchise.
Okay, next up on the checklist, management. Because let's be real, even the greatest business in the world can be completely wrecked by bad leadership.
So here he's looking for 3 basic things. 1, are the managers rational? Do they spend the company's money wisely? 2, are they candid? Do they actually admit it when they mess up? And 3, do they resist what he calls the institutional imperative? Basically, do they avoid just mindlessly copying what every other company is doing just because it's the popular thing to do?
All right, so if the business and its managers pass the test, then it's time to dig into the numbers. So the question becomes, which financial metrics actually matter the most to Buffett?
You know, a lot of people are obsessed with earnings per share, or EPS. But Buffett? Not so much. He focuses on something called return on equity, which tells him how efficiently the company is using shareholder money. And he's got this really simple test. For every single dollar a company keeps in the business, does it create at least $1 of new market value? See, he's asking, is management actually creating more value than it's holding on to? That's a much truer measure of performance than something like EPS, which, let's be honest, can be played with.
Okay, so we've checked the business, the management, the financials, and finally, after all that, we get to the million-dollar question, or maybe billion-dollar question, what's the right price to pay?
And this brings us right back to his mentor, Ben Graham, and what is probably his most important lesson of all, the margin of safety. It's not just about buying something cheap. It's about buying it with a huge built-in cushion. A cushion that protects you from bad luck or, just from being plain wrong in your analysis.
So let's see how this whole framework actually comes together. We're going to look at a real-world investment that really helped make Buffett's reputation.
Okay, so picture this. It's 1963, and there's this huge scandal. A client of American Express defaults on these massive loans that were backed by, get this, vats of salad oil. Except the vats turned out to be mostly water. Wall Street totally freaked out and the stock got cut nearly in half. But Buffett, he did his homework. He saw a great franchise with a temporary, fixable problem. So he invested 40% of his entire fund. I mean, what a huge bet. And what happened? A few years later, the stock had tripled.
And that story about American Express, it's the perfect lead-in to the final and maybe the most important piece of the whole puzzle, your own psychology. So Buffett often uses this simple story from Ben Graham to explain how the market works. He says to imagine you have a business partner named Mr. Market. And this guy, he's wildly emotional. Some days he's euphoric, he's totally ecstatic, and he offers to buy your shares for a ridiculous price. But then other days, he's completely depressed and terrified, and he'll offer to sell you his shares for just pennies on the dollar. The key here, the whole point, is to see Mr. Market not as some guide you should follow, but as a source of opportunity. It's his crazy mood swings that create those bargain prices, that create the margin of safety that a rational investor can take advantage of.
So really, the biggest takeaway from all of this is that having control over your own emotions is everything. Your ability to stay calm when everyone else is panicking and to be skeptical when everyone else is getting greedy, that is your single greatest asset as an investor. It's not about having a genius-level IQ.
So the real question is, the next time Mr. Market panics, are you going to get swept up in all that fear, or are you going to be ready to see the opportunity? And that, right there, is the billion-dollar question that really defines the Warren Buffett way. Thanks so much for joining us for this explainer.